Hello, everyone, and thanks for joining us. It's been a year of Zoom and talking to my computer here, and I'm getting a little worried, actually, that it's all starting to feel pretty normal. But we're seeing green shoots and hoping for better days ahead. So welcome to another Private Markets Insider webinar. I'm Kevin McCaffrey with Private Markets Insider and LaCrosse Investments 37.4. I'm happy to be your host today, and I hope you're having a safe and happy spring so far. Today, we're talking about differentiated opportunities in private equity and venture capital. PE and VC investors face a first world problem. How do you outperform in these already top performing segments? On a 10-year horizon, private equity funds have posted the best IRRs of any private market strategy, with venture capital, real estate, and secondaries following closely behind. And on a shorter timeline, PE and VC remain at the top, but real estate and secondaries have struggled a bit. So PE and VC have already put investors in a good position. But how do you differentiate yourself further as an investor? Do you follow the best investors? LPs are sometimes described as sheep. Well, there's a reason sheep stay nestled in the herd. You don't want to get eaten by a wolf. Your job is to stay healthy, live a long life. Spring comes every year and sheep are shorn for their valuable wool. You can do this for a long time. And if you've been part of this growing herd, you've done it quite well. But even if you're part of a herd, some positions within the herd are better than others. There's a pecking order. No one wants to be the runt of the litter. Okay, you see I'm mixing metaphors here a bit, but you probably see where I'm going. It's about seeking incrementally better performance in a top performing segment through better selection. So how do you do that? Do you meet new managers? First-time funds and other emerging managers have gained a reputation for outperformance, returning capital more quickly. You might say they're hungry and eager to please, but it's nuanced. Institutional investors in our first panel may have some opinions to share. They might have had a different experience. So what else can we do? Do you do it all yourself with direct investing programs and co-investments? You might avoid fees if you can avoid the pitfalls. You'll hear some thoughts on that from family offices and others in our closing panel. Unfortunately, there's no playbook. Private markets investing requires a network of people with experience, people you trust, people that will tell you what they think. So we're having a conversation. We're building valuable community around valued investments. And with the Private Markets Insider platform, we're bringing you webinars, live summits, and investments that we can introduce to you directly. So let's get into it. First, a couple of program notes as we review the agenda. I'm going to share the screen here so that you can take a quick look. The following presentation is for informational purposes only. None of the information shared or the opinions given are to be construed as an offer to buy or sell a security. If you have any questions for the speakers during the program, please use the Q&A feature. We'll answer as many questions as we can during this webinar, and we'll follow up afterward to answer any questions remaining and to have conversations where appropriate. I'll take down this agenda here, but these and more details on the speakers are available on the website for Private Markets Insider. And now I'd like to introduce our first panel, starting with the moderator here, Jonathan LaCrosse, as the founder of LaCrosse Investments 37.4, as well as a webinar chair here today. So thank you for your support. Jonathan has a unique perspective as an LP and as a force for good in the fundraising game. By my estimation, he put over $4 billion to work as an LP between his roles with Robert Wood Johnson Foundation for about a decade, and then working with CalPERS to launch Centinela Capital, focused on emerging managers. Then he found creative ways to bring LPs and GPs together as he launched Trusted Insight as a media and screening platform. Shortly after that, he became a placement agent, and he's raised over $4.5 billion working in that capacity. So I worked with him over the years to assist with setting up LP meetings and roadshows for private equity and venture capital clients. And now I'm pleased that he's expanding his team and the capacity for LaCrosse Investments to leverage his experience and help more clients. So with that, I'll remind the audience to write in any questions using the Q&A feature. And please, Jonathan, take it away.
Well, thank you, Kevin. Appreciate those kind words. And it's great to be here with you again. Yeah, private equity in the news today, alternative investments is so much of importance that with fixed income and a lot of credit assets underperforming or around hovering less than 1%, finding the outperformance to get to call it 8% or higher is a challenge. So private equity has consistently outperformed for many, many years, decades, as a matter of fact. And we're here with a couple of distinguished gentlemen here that are going to give us their perspectives on the keys to outperformance in private equity. So let me introduce each gentleman, and we can kick it off with one question to each. So first is Mike Groenberg from Thrivent. Mike has over 15 years of experience. Prior to joining Thrivent in 2006, he worked as a high yield analyst at Ameriprise Financial. Mike earned a Bachelor of Science in Finance from the University of Minnesota and an MBA from the University of Minnesota in 2006. He is a CFA, and he's on the board of Gourmet Culinary and MNG Direct. So Mike, let's start it off with you. What are you investing in these days that you believe will outperform the private equity benchmarks?
Yeah, so I mean, maybe just a little bit more background on, if people don't know the Thrivent brand. Thrivent has about 150 billion of assets under management, and 4 billion of that is our portfolio, comprised primarily of fund commitments and co-investments in the middle market and lower middle market. So I'd start by saying, even over the last 15 years, we continue to see value in the US middle market and lower middle market and having the best risk-adjusted returns. Except for, I think it's fair to say over the last 10, 15 years, things have changed and they will continue to change in the coming 10 years. So with that in mind, we've continued to evolve the way that our team is structured. So looking forward, over the past few years, we've had very sector focus within the 13 people on our team. So within middle market and lower middle market, we then take it more to that sector level. We expect our folks on our team to be domain experts so that we can answer those questions. Who are the GPs with the themes that make sense? Who do we view as the best at sourcing that differentiated deal flow? Who has the capabilities that sellers want to partner with? So we've taken that approach and continue to view those that provide value to sellers in the middle market and lower middle market is the place that we're focused.
Well, that's great. And I certainly have heard over the years that sector focused funds outperform. What analysis do you have that really emphasizes that, that you can share with a number of the folks that are on the phone today?
Yeah, and then as we started that more sector focus approach, it's not to say that all of the GPs that we invested are sector focused, but I think even at the lower middle market where you tend to see a bit broader aperture of what they're sourcing from, you still have those niche areas where they outperform. And as we did our more macro research, I guess don't have a lot of that in front of me now, but there was more consistency in the ability to outperform over time in each of those, and even for some of the larger funds that have multiple verticals, we look at it that way and came to the same conclusions.
Well, that's great. Thanks for joining, Mike. We'll look forward to getting back to you with more questions. Moving on to our next panelist, Alex Abel, who I've known for many years. Alex is a partner of RCP. He's a member of the investment committee and as an active advisory board member on many of their underlying funds. Alex is responsible for the identification and analysis of potential fund investments. And he's also the portfolio manager of their SBIC fund of funds. In addition, Alex helps manage the firm's research efforts as well as its customized investment solutions and advisory services. He's been involved in private equity since 2001. Prior to joining RCP, Alex founded Atlas Diligence, which was acquired by RCP. And there he developed a unique research and advisory platform focused on advanced analytics. Prior to founding Atlas, Alex worked at BlackRock Private Equity Partners, and he helped to lead manager identification and diligence there. And then prior to that, he was with Quellos' private equity group, Hewlett Packard's pension fund, and Kagan McAfee Capital Partners. He has an MBA from Stanford Business School and a undergrad in investor relations from the University of Pennsylvania. So, Alex, great to have you join. If you want to give any more comments on RCP, that would be great. And then your views on what you believe will outperform the private equity benchmarks, and then maybe you can jump to your slides and with some interesting statistics. Thank you.
Yeah, thanks a lot. It's great to be here. And I'm so happy that Michael went first, because what I say will not sound so biased. RCP is a fund of funds platform, and we happen to focus on the middle market and the lower middle market. So yeah, as Michael knows, in Thrivent, we share information with Thrivent a lot of times because we're all looking at the same funds, and we have a particular belief that smaller is better generally in terms of being able to produce alpha and outperformance in the markets. And that's our focus as a firm, whether it be on primaries, co-investments, or secondaries. That's what we do. I'll show, as just part of that, I'll actually, as Jonathan mentioned, I have a couple of slides. If people, there are people here who have heard me speak or folks from RCP speak. Can you guys, Jonathan, can you see the slides? Just want to make sure. Good. If you guys have heard anybody from RCP talk or me speak, data is a big part of what we do and we collect. We're very in an advantageous position in order to do that. And so I have a couple of simple slides that sort of highlight a relatively high level concept of why we like smaller and why we think it outperforms, or some reasons at least why it outperforms. So this is all purchase price multiple data from our internal database. So as you can see, we have about 2,800 transactions in this slide. And this slide represents all the underlying companies that were greater than 100 million of enterprise value. Now, our market that we cover goes up to about, let's say, funds that are around 2 billion-ish or 3. So we're missing from this data all the really big funds, okay? And so these purchase price multiples are probably a turn to 2 turns lower than what you might see from PitchBook or some of the other public sources of valuation data that are out there. But at the same level, you can see that the upper part of the market that we cover, it's been a significant increase in valuation, right? We know this, it's been a topic of conversation up until COVID for quite a while. And the reality is that while in 2020, we saw a slight blip down in our data, COVID didn't really change much as it relates to the valuations of the bigger companies that are out there. If you compare that, where we're sort of been in the 9s to 10 times, these are medians that are being highlighted here. In the companies that are above 100 million of enterprise value, if we go to a slide that shows the below the 100 million of enterprise value, which is really the predominant focus of most of our managers that we are investing with, you can see that it's 2 to 3 turns lower, right? Structurally 2 to 3 turns lower than it is even in the middle market, what we would consider the middle market. And there's reasons for that. You know, part of it is that these companies have some more risk. They're smaller. They have, you know, maybe less diversification of both customers as well as products. But this also presents an opportunity, right? A structural opportunity. And what it is that we find that a lot of managers that we're focused on are trying to employ a strategy that creates scale, right? Because if you can buy a company at, let's say, 7 times EBITDA, because it's a certain size, and you can grow it through organic growth or add-on acquisitions, if you can professionalize that management team, you can be a true activist investor, right? Which is what we're all paying a lot of fees for. And you can impart change on those companies, and you can get it to this slide, right? So that it's over 100 million of enterprise value, and all of a sudden the number of buyers has increased. You have different banking groups that are now marketing your transaction and auctions, and the number of people both in the financial world, private equity firms, as well as strategics are interested. You not only get the returns that get generated from growth, right? But now you have a multiple arbitrage. That has nothing to do with timing, right? So it used to be like we talked about multiple arbitrage. It was like this idea of like, oh, buying low, selling high, of sort of a market timing concept. But what really multiple arbitrage in private equity is taking an asset that's sitting here, growing it to here, where it's a much more efficient market, and you get a double dose of returns drivers, right? One being growth, one being the multiple expansion, sometimes 2 to 3 turns or higher. Similarly, in our part of the market, if we look at debt, you know, debt levels for those bigger part of the companies that we're tracking, and again, there's about 2,000 transactions here that are above 100 million enterprise value. You know, it's been sort of pretty consistent over time. It's gone up a little bit. Let's say it's 3, you know, sort of in the high 3s, like low 4s, turns on multiple, on EBITDA. And then the smaller part of the market, again, significantly less, right? So the companies that we are generally seeing, our general partners that we like invest in, are not driving returns off of debt, right? Debt is a part of it for sure, but it is a significantly less part. And again, part of it is the risky nature of the companies and the profile, but it also provides a little more flexibility when you have times like COVID, where we've seen a lot of companies within our portfolio go through difficult times, but we have not seen a lot of impairment, not a lot of permanent impairment. Certainly delays, holding periods will be longer for many companies in certain subsectors, but the impairment rates have been relatively small. And part of it is that they have manageable debt loads in general. Not always, but in general. So that's just a little data that sort of talks about why, you know, just at a very high level, why we like this part of the market. And I would say the one last thing I'll sort of add is, like, when we talk about, you know, the opportunities that we think are out there, I think, you know, besides just size, I think one of the things that we're seeing is that managers in private equity have gone from being levered strategies, right, where you're really just creating financial leverage that's generating returns, to the operating model strategies, right, where you have this, where everybody talks about operating partners and, you know, helping improve the operations of the company. I think that one of the things that we're seeing now with a lot of the GPs that we're backing, that we tend to be gravitating towards, is that they have business model transformational strategies, right? So these are groups that even in like older school, maybe not in manufacturing as much, but even in regular business services and other things, you are taking project-based business models and moving them towards subscription-type business models or recurring revenue models, right? These are all ways that can be creating value that, again, start to generate higher returns through not just the growth itself, but also the perception of that company of the buyers. And that means that they are willing to pay more for the same dollars of cash flow because of the model that that company is being utilizing. And then on sector edges, I mean, we totally agree. Like, we do generalists, we do sector specialists, and we look for groups that have an edge, right? And that edge is something that allows them to source better. It allows them to win deals, which in a very competitive marketplace is as important, right? To be able to convince the seller, especially in our part of the market where the seller often rolls over a significant amount of equity. So they want to partner, right, for that quote unquote second bite of the apple. And that it is also that expertise or that edge allows them to hopefully accelerate growth and minimize risk in a way that a generalist might not be as good at. And what we found is that we invest across all different types of sectors. You know, things like consumer, healthcare, industrials tend to be the largest ones from a sector specific. And while they have been generally good and bad in differing ways, they all have some specific risks, right? Consumer is a little scary. We do consumer still, but like it's a little scary to do consumer these days. Healthcare valuations has been the biggest concern, right? You have huge tailwinds in a lot of these companies, but the pricing in that part of the market has been very aggressive, right? And industrials, we've seen a lot of industrials go through a really difficult time over the last 2 years, in part sometimes because of things like tariff policy, which really hit a lot of companies in various parts of the portfolio, input supplies from overseas. So while their sector specialists are always very good, like we're always looking for groups that are very good at identifying those types of risks, mitigating them, and still being able to generate returns through multiple cycles and macro events. So I'll stop there.
Well, that's very helpful. Great statistics as always, Alex. Appreciate that. Appreciate all the hard work done by RCP and your team. So let's go back to Mike. And I know you guys at Thrivent are always looking for strategies that are uncorrelated, that have the opportunity to beat the public markets, and looking for that low to mid-teen type returns that with lower risk. Maybe you can expand on that, Mike, and tell us about that strategy and how you're outperforming there from a risk-adjusted basis.
Yeah, and maybe to put that in perspective, when I started at Thrivent in 2006, it was a U.S. middle market focused strategy, and we had a few $100 million of AUM in private equity, and now we're around $4 billion. And with that growth, we're still focused on middle market, lower middle market, but wanted to diversify from that as well as our public exposure here at Thrivent. And what we were seeing was passing on a lot of opportunities that were in that low teen kind of return area, but had great risk adjusted returns. And we expanded our mandate with this complementary sleeve that has less correlation in many ways. But in the end, when you've got low interest rate environment and a flood towards risky and illiquid assets, it seems like everything is correlated in some sense. But our complementary strategy either has diversification because of the end markets they play in, think perhaps some niche infrastructure, things like that, or where they sit in the capital structure. And particularly leading up to COVID, where we felt we were in a very frothy market. Ideal example is in technology, and even today you see super frothy valuations where some of these structured equity opportunities were more in that 5 6x types of range in their structured product, and you had 7 turns of equity behind that and a very similar return profile. So we like that type of thing. So within that complementary bucket, we're proactively considering strategies like structured equity. We have invested in some structured secondaries, and we're looking at some of these special situations and GP stakes. And then on an opportunistic basis, there's a whole number of smaller niche strategies that aren't as large that we've definitely looked into, whether it's some of the royalty or litigation type asset things. And that's why I started my comment is, even though they're less correlated, it would seem that with the reach towards yield and towards less liquidity to generate returns, even we're seeing frothy valuations in those asset classes.
I love it. I love hearing a lot of investors don't touch those asset classes you just mentioned, and they're way on the margin. So glad to hear that you guys are being aggressive there. Alex, let's go back to you, because I know a number of the SBIC funds have outperformed and quite significantly. So there's obviously investing via the equity, investing via the debt. Maybe you could talk about your strategy there and what has outperformed in overall. That'd be great.
Yeah, in our SBIC fund that we raised and committed, we were focused on strategies utilizing predominantly mezzanine strategies, right? So these are with certainly equity components to it, various levels, sometimes as low as 5 or 10% of the invested dollars, sometimes as high as 20 or 30% of the invested dollars. And the SBIC program, and I've been relatively involved in the SBIA, which is an organization is sort of the lobbying group for the SBIC, as well as small, private equity in general. The SBIC program long ago was one where there was a perception, certainly, that it was a place where managers went when they couldn't raise money, right? And it was a way of getting easy capital from the government, and they could lever it 2 to 1 and allow them to sort of raise funds and create a business, where the traditional LP route was, let's say, less interested. That has changed significantly over the last 10 or 15 years. And the reality is that the quality of managers that are going to use the SBIC program, specifically in the private capital, private debt sort of strategies, which is what the predominant amount of the strategies are that are utilizing that program, have really attracted, frankly, some of the best investors in those spaces that are rolling out of banks and other sort of other groups, because the economics are quite attractive for them. They have the ability to raise $100 million and essentially lever it 2 to 1 and charge fees on that entire amount, including their carry. And the leverage that they get from the federal government, it's not actually directly from the federal government. I won't go into the boring details of how it works, but it is backed by the federal government, so that they are borrowing 10-year fixed debentures at the fund level, effectively, at rates that are usually 50 to 70 basis points premium to 10-year treasuries. And that's pretty cheap fixed debt. And when you are, lending it out at, it used to be 13, 14%. Now it may be 12 or 13 or 11, 12. You're still getting 9, 10% spreads on that money at a levered 2 to 1 basis. And that can produce some pretty attractive returns in a mezzanine strategy that has less risk than a private equity strategy, but with returns that can often look a lot like private equity. Not the best private equity, but let's say the medians of private equity, right? So let's say a 2x and can be approaching 15 to 20% IRRs in some cases, right? So it is an area that has continued to grow, and that program has continued to grow. And I would say that on a risk-adjusted basis, it could be one of the most interesting places from a private capital perspective.
Yeah, fascinating. Thanks for your thoughts. Mike, let's go back to you. So I've been doing this for over 20 years and met with a lot of GPs, and every GP can find a benchmark that says that they're top quartile. So how do you really dissect that and then pick the managers out there that are truly top quartile and that are going to continue to be top quartile down the road?
So, as we're evaluating GPs, right, we want to, as Alex said, you want to find that differentiation. And if you start ticking down the attributes that we look for, right, we're looking for those GPs that are focused within their niche, whether it's their sector or their type of transaction. We look for strong leadership. We often talk about that in terms of the portfolio companies they manage, but it's just as important at the firm level as they drive forward and attract or retain their talent. We're looking for that differentiated sourcing and value creation. Alex mentioned some of the operation capabilities people bring. We're seeing a lot, even in consumer funds and other funds, they're sourcing platforms that have the capabilities of scraping social media sites, other websites, as they're looking for utilizing that data to look for potential platforms and or executives where they can bring talent to their existing portfolio companies. So we're seeing lots of that evolution occur. But then perhaps the most important part for us is for our team, we try to hire transactional focused people. And as we go through our diligence process, as you said, Jonathan, there's often a marketing pitch and then there's what's happening. So going deal by deal, and in this environment where funds are raising very quickly before you can see real traction in their performance, having that deep dive on a portfolio level basis to match the marketing spin with what's actually occurred in the portfolio.
Thank you, Mike. So I'd love to get the perspective of both of you guys. And then also just want to mention to the audience, if you have any questions, please write them in to the Q&A and we'll try to get those asked. But one question here, Alex, you guys do a lot of analytics and Mike, be interested on your perspective. I know Cambridge does a lot of analytics, benchmarking LP performance against your peers. For fund of funds, how do you stand out against fund of funds? How do you stand out against other endowment foundations, insurance companies, asset managers, Mike? So Alex, what makes an LP really stand out and makes you guys be a top performer?
We're of course a top performer, in our benchmark. I mean, for us as a fund of funds, look, we're judged on our net, right? We call it net returns, right? So not everybody puts the net returns in the deck, and they look at their net gross. At the end of the day, we have to be able to achieve returns to our investors that are attractive after our fees, right? In order to sort of prove the value, the add that we have. We have a model where we have our fund of funds is separated into the three different categories that most groups like us do. So we have a vehicle for primary fund investing, we have vehicles for secondary investing, we have vehicles for direct co-investing. They're not mixed in one vehicle. And that can sometimes cause issues for us with some of the sort of broader benchmarks, because if you add our co-investment stuff into our primaries, like a lot of groups do, we look really, really good. And then sometimes when you have to take those out, we don't look as good, and we still think we're very competitive. But I think the way we get judged as well is consistency, right? So we raise a fund every year, pretty much every year these days. And, we have 20 years of history. We're currently raising, we just finished investing and raising our 15th fund. And so, we have a lot of proof points, right? So like Michael's, said, when we do our due diligence as well, we're looking for what the proof points are. They don't have to be finalized, realized deal, but we have a lot of information that we can provide our investors and our prospective investors to try to show the consistency of our returns over a long period of time, and hopefully backed up by process, right? Like having a repeatable process in terms of both sourcing and identifying managers. And I think we've done a good job of showing that for ourselves. And I think that for most LPs, I think it is the consistency factor, which is should be the most important for how they're judged in private equity investing. All of us can get lucky and invest in a fund that, hits a 3.5x, right? Those are a little bit of unicorns, right? In some ways, what we're really judged on is by avoiding the bad ones. Because if you have a very good portfolio of managers that have good outcomes and you have one or two that really overperform, if you can avoid the one or two that underperform, you're going to have a really strong portfolio.
Mike, do you want to comment?
I mean, maybe the only thing I'd add is our net performance would be our fund net performance combined with our co-invest portfolio, since it's all on the Thrivent balance sheet. And so that is one lever that we certainly have pulled over time that's really played into outperforming our benchmarks. And maybe there's several benefits we see to co-invest, but maybe I'll just mention two here. One is you really get to know your GP much better at a granular level. And I think that just makes you a far better fund investor, evaluating both that GP and then the GPs for pattern recognition going down the line. Additionally, our team finds the co-invest work very rewarding. I think you can attract better talent, and I think they become far better investors by having that experience.
Thank you, guys. We have a question from the audience. What are some of the indicators used to measure GP differentiation? In fact, what are some of the differentiating factors? The speaker mentioned strong leadership as one of those differentiating factors. Somebody want to take that?
I can start, and Michael can bail me out if I flail a little bit here. Look, I think that, you know, for us, there's really two sides to that equation, right? One is the quantitative side, and one's the qualitative, and they're equally as important. You know, we talk a lot about data stuff because it's interesting, it's somewhat unique, but like the qualitative assessment of people is probably as important or more than anything having to do with their actual track records. On the quantitative side for us, you know, we are really what we're really looking for is ways to measure their outcome compared to their peers, which is basically benchmarking, right? But in unique ways, right? So, you know, vintage year fund level benchmarking has a lot of limitations in terms of being a predictor for future performance, as well as sort of understanding how well a manager has really done against their peers. Like Michael, we spend almost all of our time at the deal level, both in terms of analyzing case studies in sometimes excruciating detail with a manager, you know, looking at their investment memos. And we also have the ability to, because of our data and our informational flow, to benchmark managers on unrealized deals on a variety of metrics that have nothing to do with final marks, right? So we have the ability to look at a manager's revenue CAGR growth in their portfolio for given companies of a given size in a given subsector, and we can tell whether or not that's better, worse, or the same as their peers, right? And so if the goal of benchmarking is to separate out luck from skill, right? And luck maybe is the wrong word. Let's say market forces from skill, right? Which is alpha. Then we try to do that at the operational level, not just at the marks that are being given at the financial statement level or, you know, the thing. And then on the qualitative side, you know, look, we do extensive referencing, right? And, you know, and having an ecosystem of contacts that we have that are very warm contacts where we systematically keep in touch with folks in a way that allows us, and this is GPs, it's intermediaries, it allows us, if you can get to that, the true references, right? Where you get actual insightful information and not just the going through the motions, this guy is great, blah, 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 right? Like that, like those true references help you avoid mistakes, right? And help you sort of confirm narratives or things you think about a manager that do make them exceptional, right? And it's hard to do that from the outside. Again, I totally agree with Michael, like our co-investment activity does a tremendous amount to getting us to understand at a very deep level what a manager does and whether we like them or not. But outside of that, the best way is to really talk in an honest way with people that know them and have worked with them in various types of ways.
Anything else to add there on that question, Mike?
I mean, that's one where maybe, you know, if you break it down into their strategy and the themes they're pursuing, their sourcing, and the value creation that they have, which includes the ability to sell to that seller. I just give a quick example. This last year, as Alex pointed out, there's you know, lots of twists and turns within niches within industrials broadly. One fund that we invested in last year, we like because it has that macro theme of continuing benefit from you know, low energy costs in the U.S. We've got greater automation, onshoring. So last year we committed to a fund that focuses on service businesses that support infrastructure and view that as a neat niche way to play industrials. Think maintenance, repair for electric, gas, water utilities, telecom. We view those businesses as taking advantage of a more, you know, stable end market, the growing demand, more outsourcing with the aging of the workforce. This fund, this GP providing that insight in specializing in those areas that have that stable and growing end market, sourcing advantage because of all they've done and the mapping of the market they've done, and they have true value creation that they can use to sell to the founding and sellers that are selling their business.
I think we're in the same fund.
Yeah, I just sourced an independent sponsor deal yesterday that in the infrastructure services space. So it looks like it's doing pretty well. Anyway, I see Kevin jumped on the screen. 30 seconds. What's your biggest concern on a macro level going forward for the rest of 2021? Mike?
Yeah, so I mean, the easy answer is the compression caused by the continued low rate environment that pushes capital to more risk and less liquid strategies. Personally, I continue to be concerned with the frothy the asset prices in areas that are dependent on, very high growth rates and very little near-term cash flow, where you're dependent on that high terminal value and your valuation.
Yeah, I mean, I would agree. I think that, valuations right now are, for many companies, are priced to perfection, meaning like, their management case style, like underwriting, and private equity firms, because of the amounts of capital that they've raised, oftentimes in greater amounts than their historical funds, sometimes feel pressure to put equity to work, and they're willing to pay an extra turn to win a deal that they've been working on for 6 months, right? And can justify and sometimes over justify the valuation that they're willing to pay in those situations, and it's based on nothing going wrong, and that's the worry. I think we're not worried about huge impairments because of these types of things. It's really more the risk is mediocrity, right? Mediocrity, like not bad returns, but like you can't generate the same level of returns when you've overpaid for an asset. So.
Well, excellent analysis, gentlemen. Thank you so much. And Kevin, sorry we went 2 minutes over, but it was a great conversation. So it's all yours.
Totally understood. We could go for 2 hours with just this group. And thank you so much, Jonathan, Mike, Alex. So that's taking us now into shifting gears to dig into the VC arena. And in order to set up that conversation, we have one of our other webinar chairs here, Charles Sidman, here to create some context with a fireside chat with one of his colleagues and co-investors as they discuss early stage VC as a distinct asset class and why this matters. So Charles Sidman founded and directs ECS Capital Partners. He's a co-founder of the American Angel Capital Association and a past president of the Crowdfunding Professional Association. Charles is a frequent advocate and speaker on financial entrepreneurship, policy, and ethical issues globally, and an enthusiastic participant in numerous investment and professional organizations while supporting early stage companies through angel investing, venture capital, crowdfunding, and public markets. Dr. Sidman retired as professor of molecular genetics, biochemistry, and microbiology from the University of Cincinnati's College of Medicine. His education includes a PhD in immunology from Harvard, an MBA from University of Cincinnati, and sabbatical study on complex systems at Santa Fe Institute. So more than qualified to lead us in the latter half here as we jump into your discussion. And with that, Charles, please take it away.
Thank you very much, Kevin. It's a pleasure to be here with everybody today. We're going to first introduce Neil and myself, and then we'll go over a number of points, focusing on why the view that early stage venture is a distinct asset class by itself, different from later stage venture, and then describing the fund which I have put together to execute and capitalize on these insights. So Kevin introduced me a little bit, and maybe I can turn it over to Neil to introduce himself, and then I'll come back and give more introduction to me. So Neil.
Great, thanks, Charlie. Nice to be here today with everyone. So my name is Neil Littman. I'm the founder and general partner at Bioverge. Bioverge is an impact investment platform and venture firm focused on democratizing access to early stage healthcare investment opportunities. We are focused on funding visionary entrepreneurs with the aim of transforming healthcare and bringing science fiction to life. Importantly for this discussion, our sweet spot is early stage venture asset class. We've built a portfolio of 24 companies over the last several years that span the intersection of health and technology. So I am excited to be here today and have a fireside chat with Charlie.
Neil, thank you so much. You're going to see during our fireside chat how Neil and I really resonate with each other. He is on my advisory board in my fund, and we are co-investors in a number of deals, and we share many of the end goals in our activity. So just to introduce myself a little bit, more. My professional career has had 3 phases. The first phase is I was a computer guy. I designed and built hardware, and I programmed it to do some amazing things. We were doing in the early 1960s what is now broadly known as artificial intelligence. And we were capitalizing on what we called timeshare computing, but that became today's internet. Second phase of my career was in biomedical research. And three things were prominent during those years. First of all, I got my PhD in immunology, and I was involved with figuring out how the immune system actually works and how to apply it. Many of the companies that Neil and I invest in use these realizations and discoveries. Secondly, I was involved in the very earliest stages of genetic engineering and genome analysis, and we'll see, everybody knows how important those activities are. And thirdly, I've been involved in a new paradigm, way of looking at the world called complex systems. It permeates everything we do here. And then the third phase of my professional life has been as an investor. I was at a sabbatical at the Santa Fe Institute. I met this really strange, fascinating guy. He told me he was an angel investor. I had no idea what that meant. I got into it. I was totally seduced and overcome. Got into it seriously myself, and that became my third phase of professional activity. So Neil and I are both involved in this early stage venture world now, and we work together quite a lot. And he's going to challenge me. I'm going to challenge him during this conversation. So the first thing we want to talk about, I want to just present the concept that we both feel that early stage venture or angel investing into young companies is a distinct asset class. It's different from later stage and what is more commonly known as venture capital. And we have a concept here that these companies have common characteristics which are more important than the particular financing mechanism by which we participate in them. So it's not about public markets and private markets. It's about young companies who have potential and probability and possibility and people. But what they don't usually have is a lot of hard historical data. They may not even have product market fit. They're often pre-revenue. And so that indistinctness or fuzziness requires unique approaches, but it leads to the first characteristic of this asset class, which is an amazing IRR. The earlier panel talked about low teen rates of return. The best data we have for early stage equity is that the average returns are 25 to 30%. And given the way that the curve is bounded at the bottom by 0 and can go as high as, to infinity, what that means is a lot of people don't do it well, but people who do it well have a higher return than the 25 to 30% average of the field. So it's real attractive. And that bakes in all the risk and uncertainty that we all know about. Secondly, it's a highly uncorrelated asset class. Everybody here knows about and values lack of correlation. The basic reality is that even in the worst of economic times, inventions are being made, discoveries, developments, value is being created. So even if the classical markets are taking a dive, the early stage is still producing value from nothing. And then lastly, the significance of this asset class. It's estimated, a lot of statistics show that the majority of new jobs, new standard of living, new tax revenues, et cetera, come from the young companies, the ones who are pushing the envelope. And those turn into the raw material for the later stage investors that we all work with. And why is this really important? The basic illustration would be, we deal with discovering and working with the Wright brothers when they are inventing aviation, or we deal with the development of companies using CRISPR, which allows almost infinite genetic modification. If you wait until later on, these things become part of the world. And yes, you can invest in Delta Airlines or a well-developed healthcare company, but we're getting in at the very earliest stages thus giving the opportunity for a very high rate of return. So that introduces why we think early stage is a distinct asset class. This is different from late stage as real estate. Neil, anything to add on this first point?
Yeah, thanks, Charlie. If I could jump in and maybe just ask you a question or two. As you rightly point out, as we're investing in this asset class, we're not looking at historical financial data necessarily, not looking at EBITDA margins or growth rates, for example. A lot of companies don't have product market fit. So as you're assessing technologies and companies to invest in, right, there's a number of things you can look at. You can look at the team, the market, the technology. Do you overweight or underweight any of those compared to the others?
All right, well, that goes to the essence of what we do. For me, we always have a vision, and the entrepreneurs and founders have a vision. We have to buy into that as a possibility. We have to try to evaluate its probability. And for me, the two things that are probably highest importance after that are, first of all, the people involved. They lay out business plans, and that's the basis of our discussion. And we give and take and challenge. And it's during those discussions, we all know that the business plan isn't going to happen, but how they respond to the challenges and the uncertainties and the what ifs and what's your backup plan, that really tells us about the people involved. Secondly, the people that we're talking to have all drunk their own Kool-Aid. And so for me, it's very important to identify either a first customer or even a potential customer who's neutral and off to the side and is willing to say, if they can provide this, I'm buying it. It solves my problem. That's the neutral opinion that I really need. So how's that as answer to your question?
I think that's great. And I think that actually leads into the next topic I want to touch on, which is describing ECS and how it fits into the broader asset class. You talked a little bit about sort of the asset class in general. I think you have a pretty differentiated approach when it comes to investing in early stage venture capital. Can you talk a little bit about, you mentioned how you evaluate companies, talk a little bit about how you apply that to your investment strategy.
Okay, well, do you mind if I first give an overview of what ECS is all about, and then we'll get into how we do it actually?
Of course.
So what ECS is all about is, I've been in analysis and research and discovery and understanding my whole life. And as I spent 20 some years in this early stage asset class, I've come to realize that there are problems, there are opportunities for vast improvement. So we have a landscape of investors, entrepreneurs, governments, other stakeholders, citizens, society, et cetera. And they tend to work all by themselves. They don't collaborate enough. So the silo problem. One silo is an enormous number of potential investors who don't invest. The whole system is deprived of their energy and activity and financing. That's a problem. We have the early stage investors who are often angels. They perform a unique, invaluable function of meeting the entrepreneurs for the first time and identifying them and coaching them and supporting them. But they often don't have either the expertise or very often the money to carry it home. Then you've got players with bigger pocketbooks, funds, high net worth individuals, family offices, et cetera. They have all the money that they can use, but they don't have the visibility and access into the early stages. So they don't know which companies to back. And then, so all of these players are doing their own thing kind of by themselves. And that's the problem that ECS is designed to help solve or improve on, is to integrate and synergize all these different players using the access and the financial resources and the expertise in the different silos together to make the whole thing work better for everybody. Now, that's the intent, and it applies to early stage equity as a whole. Additional choices of ECS are, one, we focus on sophisticated science and technology-based enterprises, so-called deep tech. And we do that because, one, intellectual property is patentable, protectable, and it allows outsized growth and thus outsized financial return. Secondly, my background in sophisticated science and technology is where I naturally fit in. And thirdly, or as another choice we make, ECS focuses on impact investments, investments that besides aiming for outsized financial return, also make a positive impact on the world. And it's my thesis actually that the impact is not just a convenient or comforting add-on, it's actually an essential, because solving a sustainable, long-standing, real problem leads to a better, sustainable, real business opportunity. So those are the two types of, or gates through which ECS operates: the deep tech and the impact.
And Charlie, could I just follow up with a question on the impact side of the equation? So, I often run into folks who, are interested in impact investing, but are concerned that you might sacrifice returns by going after impact investments. Could you talk a little bit about how you think about that?
Sure. To me, that's a false dichotomy. As I was just trying to say, impact helps identify the best business opportunities. In the old days, when we called impact CSR, companies that had that lens did better purely financially, purely business-wise than companies that didn't. So my IRR target is to be above the average, and I do that. I think I can attain that largely through, for me, impacting and technology investing. There are other ways to do it. I don't want to say this is the only answer. Consumer goods and video games and sports and entertainment. There's all sorts of ways to make a lot of money. But this is a way that I think is possible for me to contribute to, and for my investors to benefit from. Related to that is, it's the IRR that really matters to me. And there's a lot of talk about unicorns and home runs as very infrequent but very rewarding events. That's not the only way to attain this IRR, in my opinion. An investor or an investment group that gets 1 out of 10 investments to be a unicorn to pay off the whole activity, that is one approach. Then they have to live with 8 or 9 failures out of those 10. But another approach is to have only 2 or 3 failures, 8 or 9 base hits, gazelles, with some occasional unicorns. That's another way, and I think probably a more reliable and reproducible way of attaining that very high IRR target. So I don't see impact as an alternative or a sacrifice. I see that as one of the component ways to achieve this goal.
And so, Charlie, I think that's a nice segue. You mentioned a little bit about your strategy, your differentiation at ECS. I'd like to dive into that a little more, just in terms of what differentiates you, how you source deal flow is critical in the early stage venture business. So we'd love to understand a little bit about how you go about sourcing your deal flow.
All right. Well, this is one of what I consider our sources of differentiated advantage. I'm going to be a little bit immodest here, but I think I have an unparalleled diversity and thus ability to select among deals. And I'm going to illustrate this with some sample investments in the closing segment here. But I work with the United States funds over 5,000 early stage deals a year. They're considered angel deals. I have visibility into a good number of those, and I have visibility into a good number of those that are outside the US. So the diversity of opportunities through many different channels is one of my strong points. Secondly, that gives me a diversified team that I work with each time. So my style is to co-invest always with other investors, which means we can share the diligence. They do some, I add more based on my own science and technology and personal evaluations. So I think the diligence we do is improved. And actually, it's been suggested that my scientific background is actually one of my main secret sauces. Another thing I'll point to is that we focus on a portfolio in this early stage asset class. We don't just publicize deal by deal and invite people to participate. We guarantee a diversified multi-stage portfolio for every one of our investors. And that means we divide their committed funds into 4 buckets. The first bucket, quarter, goes into several hundred early stage companies at a small investment level. Out of those several hundred, we then commit the second quarter of their funds to maybe a fifth or a tenth, 1/5 or 1/10 of the initial companies with a larger investment, a follow-on when it's warranted. The third quarter bucket is further follow-ons yet. So every one of our investors is going to have a multi-stage representation of very early deals, and then deals that are getting more of their resources and are proving themselves, and finally deals that are just scaling off the charts, and they will get to participate in all of those. My goal is to deliver each of our investors that portfolio. Now, having said that, our larger investors can also super invest or put additional funds in deal by deal in the later stage, larger deals. And so that gives them the opportunity to be active investors as well as passive beneficiaries.
And Charlie, I always find it helpful with examples. Are there maybe a couple of examples from your portfolio that you could share with the audience today? Because I know you cover sort of a wide range in terms of your deep tech investments. So a couple of examples are always helpful.
Right. So that's a good way for us to close this fireside chat. In the last 20 years, I've made more than 100 investments in this early stage arena, more than 40 in the last decade. And over that time period, health written large is my biggest single sector, slightly more than half my investments. Sustainability and energy have been another quarter of my investments, then a scattering of other things. So I'm going to tell you about a couple of investments, both in the health arena and a couple in the sustainability arena, very briefly. What you're going to see is that my investing style tends to go for concrete and technology-based investments over virtual or consumer brand. Other ways, for other folks to make money, it's not what I do. I want something concrete and technology-based. So I'm going to give you several examples. The first one is a company called AssureX. It was based on the genetics that I know so well. It was the ability to determine for an individual patient, personalized medicine, which medications they should take, the ones that would benefit them, the ones that might harm them. And that grew into a semi-unicorn. It was an M&A acquisition. I made 6 to 7 times my money on that one. I was very happy with that. A second one, a very recent one, is called MP Diagnostics. It's a Swedish company. It also came from the angel world, but this time from the European Business Angel organization. It was presented at an event in Ireland. I invested in this Swedish company with colleagues from the south of France, and this company is solving the tuberculosis problem first targeted to India. TB is actually bigger than COVID and more long-lasting than COVID as a global health risk. And these guys can crack that problem. A third one I'll mention, MedCura, I got from a crowdfunding platform. I then went into personal due diligence. I invested against all my usual norms via a safe note in the beginning. It's now in regular priced rounds. It's absolutely flourishing, blowing the top off the chart in bleeding control. It's in military and civilian use and manufacturing now. A fourth one, Alveo Technologies, I'll mention because it came through a Wall Street investment banker channel. It's recently won the X Prize from over 700 applicants for the best COVID detection, point of care, cheap, fast, rapid detection for COVID and other, noxious viruses. And so now it's going to probably have an IPO within the year. The last two I'll mention, one is X-Row Technologies. I met it at a Canadian small cap conference. It happened to be a public company already, even though it was the same valuation and totally pre-revenue when I got in. It's done fabulously well. It's close to being a unicorn already. I built up a position gradually. I've returned my original contribution, but that's given me a 30x return, and it has a long way to go. And finally, I'll mention Nexteon Technologies. I met this at a closed door space technology meeting. I was there as a speaker, a participant, high security, but I was behind the barrier, and I met the company, the people in this company. These people are revolutionizing global aerospace navigation and guidance. Pretty soon, every flight any of us take will be guided by these people's technology. So huge opportunity. It's also impact, because it's going to save probably a quarter of the cost of maintaining and fueling and polluting in the whole aviation industry. So the takeaway, these are 6 different deal sourcing channels. Most organizations use 1 or 2 of these, and they're not the only 6 that I have. So it's a distinct opportunity, conceptualization of the asset class, a distinct way of utilizing it, and it's full service. Someone can be either totally passive or active with us, and I don't think anyone else offers this range and set of resources today. Any last comments, questions?
Great.
You or anyone
Charlie,
else?
I see Kevin has jumped on here. I don't know if we have any questions from the audience. I know we're 2 minutes over time, but we started 2 minutes late, so I assume that's okay.
Right.
Right. Yeah. No, we didn't have anyone chime in specifically with questions. I know this is a bit of a shy crowd. We get a lot of investors and so on that are watching and listening carefully. You can also write in to me with any questions, and I'll pass them along to Charles. Any interest in those specific examples? There's really a lot to dig into there, so I know that we could continue. But I think what may be important, I'd like to thank Neil for participating and kind of helping with that chat. But now we're going to move on to Charles' discussion with some panelists, some investors that might be able to challenge you in a different way as we discuss seeking strong returns in venture capital. And we're bringing on Howard Gerbich and the Gerbich Family Office, Jerome Antonin with Truvo Partners, and Kevin Moore with Spur Capital Partners. And Charles, I'll let you, determine the order for some introductions and questions. Please continue.
Okay, well, thank you very much, Kevin. And Neil, thank you very much for the round just concluded. So I'm going to be managing this discussion, speaking less, giving my colleagues here on stage the opportunity to have most of the airtime. But I'm going to ask each of them to introduce themselves in a moment. But one of the particular items that I'm interested in their explaining is their particular approach. Do they regard themselves in their activities as specialists or generalists? And the analogy I might make is Tom Brady, he wants to be the best quarterback in football. Bill Belichick wants to be the best general manager and coach in football. Different of us are generalists or specialists. And so I'm interested in as our colleagues introduce themselves, if they could identify their role and approach in this asset class. So perhaps we can start, and after the introductions, I'm going to ask an initial question of each of them. So Howard, would you like to introduce yourself to the group?
My pleasure, and thanks, Charles. We are, I guess by definition, a bit of generalists, although we have particular interest in areas where we think we have the potential for greater return, since we are generally agnostic. We are agnostic as to verticals, as well as public or private market equity or credit. We are also agnostic as it relates to whether it is a direct investment that we're in control of, or it's a pooled investment where we are one of a number of investors, or whether, ultimately, whether it's individually or collectively, we are majority or minority partners. I say that we are generalists in the sense that while we invest and have a significant focus on technology and biotech, when it comes to biotech, with limited exceptions, we're really not capable of understanding the chemistry or the biology to the degree that's required in order to make informed decisions. Also, in the area of biotech, we don't necessarily have the relationships that we have in the area of technology, so we are less likely to see directly the opportunities that we'd want to see, and we are always quite conscious of suffering adverse selection and only seeing secondary or tertiary opportunities that are being presented to us. So when you combine our lack of access with our lack of detailed, chemistry, biology backgrounds in the area of biotech, we are more likely to be a co-investor or perhaps do this via funds or co-investments through the funds that we are otherwise invested in. Whereas in the area of technology, we are quite comfortable making direct investments, co-investments, or unlimited, situations, investing, through fund vehicles.
Okay, well, thank you very much. And I'll be back with you in a moment with a targeted question. So, Jerome, perhaps you could introduce yourself to the audience, please.
Of course, happy to. Thanks, Charles, and thanks for having me on the panel today. So Jerome Antonin, I'm a partner at a firm called Truebill Partners, where we serve as an outsourced investment office to ultra high net worth families. We've been doing that since 2007. And for our families are responsible for doing asset allocation, both strategic and tactical, as well as investment implementation across asset classes. We do that primarily by partnering with third-party managers, but we also are reasonably active investing directly into private companies and assets, which obviously we'll get into here. As it pertains to the generalist and specialist question or comment, I would say that we're a little bit of both. So as a firm, we're generalists from the perspective that we're opportunistic, investing across different strategies globally and looking to partner with the best talent that we can find, both fund managers and entrepreneurs. But as an investment team, do have specialization. And so as myself, I focus specifically on equity-oriented investments, actually both public and private, which we feel actually gives us an interesting lens as it pertains to the synergies that can be achieved investing across the continuum or life cycle of companies, from the public markets to from the private markets to the public markets.
Hey, well, thank you so much, and we'll be back to you momentarily as well. And last but not least, Kevin, Kevin, please introduce yourself to the audience.
Yeah, Charlie, thank you very much, and it's a pleasure to be on the panel today. My name is Kevin Moore. I'm a partner at Spur Capital Partners. We are an early stage venture capital fund of funds manager with a specific focus on early stage venture. I certainly think it's a great question in regard to generalist versus specialist. We believe that venture capital is such a nuanced category that to really flourish in this space, you gotta be a specialist. And that's kind of how we view ourselves. We don't invest in any other category except early stage venture capital. One of our partners, Paul Gompers, is a professor at Harvard Business School in addition to his role at Spur Capital, and has wrote extensively on this topic of venture capital, private equity, entrepreneurship, et cetera. And we've really used that research to inform how we make decisions within the organization. So, we invest broadly across technology and life sciences. And to Howard's point, we're not experts in life sciences or technology, but at the high level, we understand how this industry works. And I think that there's different reference points that you have to be able to follow to really understand and select the best VCs. And happy to share a little bit more on that about that later.
Wonderful. We'll give you the opportunity for sure. Okay, well, I'd like to move now into a prepared question for each of our panelists, because I know from preliminary conversations that they all have opinions and experience that they would be willing to share about these points. So like to go back to Howard and ask him for his thoughts on portfolio construction and stages that he likes to participate at. Howard, you willing to take that up?
Yeah, no, happy to. Where I think Charles is coming from, we invest from seed to late stage growth equities, and we've got a fairly large portfolio of public equities. But one thing I feel very strongly about is that unless one is able to invest across the spectrum, I think that investing, particularly in technology and biotech, is very difficult for a number of reasons. One, I think that if all one is able to do is invest in seed or A rounds, it is very difficult, in our opinion, to make money doing that. Because if you don't have an ability to continue to invest in later rounds, and one will get significantly diluted as it relates to those companies that are ultimately successful. In addition, it becomes, in our mind, the only successful way to invest in early stage technology is if you've got $100 to invest, perhaps invest 50 of it across a portfolio of companies. And if you're fortunate enough to have 1 or 2 or 3 winners, you want to make sure, in this example, to have another $50 available to really back up the truck and invest in those breakout winners. And so I also think that without an ability to demonstrate to founders or other sponsors that you have an ability to continue to be a follow-through investor, I think that there is so much capital in the world and there are so many sophisticated investors out there that it is very difficult if you can't convince these founders and sponsors that you're going to be with them out for the ride, rather than you're just going to be a foundation or a seed or an A-round investor. And so we are big believers in building a broadly based portfolio and continuing to put substantial amounts of money behind those companies that appear to be breakout companies, which you never really know. As I'm sure many on this call know, oftentimes when you're backing a founder or a serial entrepreneur, it's not unusual that the profile, the business of that company evolves over time. And even if the business continues to develop as was originally conceived, it's impossible to handicap at inception which companies are really going to be successful. And the founders and entrepreneurs themselves are equally incapable of figuring out which of their startups are going to be successful. So again, a broad base of underlying companies with an ability and a willingness to continue to invest through successive rounds, both to ensure that you get access, 2, so that you get the benefit of those winners, and 3, at a minimum, you don't suffer substantial dilution, wherein you see a company that had, I'm making this up again, a $50 million initial valuation goes to $1 billion, and you're surprised to see how little appreciation or accretion you got in those, at your exit date, because you weren't able to participate in subsequent rounds and were substantially diluted.
Right. Well, I agree with you completely here. And actually, in your $100 example, I only put 25 up at the beginning and keep 75 for the later rounds. But a follow-up question to you is, I see the possibility, and in my mind, probability, that the situation you're describing is somewhat different for private companies versus public companies. And I wonder if you'd like to comment on that, or I can specify what I'm thinking about more. I'm thinking about the waterfalls in private companies with successive rounds are quite arcane sometimes, as opposed to public companies. Generally, even if they continue fundraising, it's still common stock. Every share is identical to another.
Yeah, I think that the comments I made are really, from our perspective, really focused on private companies. I'm less concerned in the public markets. Ultimately, we make a decision, how many dollars when it comes to public company, we would think about how many dollars we want exposed to the sector, to the particular company. And that's really a much different analysis than in private companies, where, we want to often, minimize the dilution going forward, and if possible, actually increase our ownership percentage in those that we think are going to be successful.
Right. Okay, thank you so much. Now, moving to a targeted question for Jerome. Jerome, I know you have some thoughts about your experiences in the past about direct investing versus co-investing versus, let's say, fund investing. And can you tell us about that and your preferred stage of investing and how you like to invest, find it most effective?
Yeah, absolutely, Charles. Thanks for the question. Certainly can piggyback off on some of the comments that Howard made in that regard, as it pertains to, investing directly in companies at the earlier stages. So I guess a few comments there. The first one of which is whether we're investing in funds or whether we're investing, directly into, venture capital stage companies, the answer varies a little bit, right? And so I would say that, from the perspective of fund investing, our preference is definitely to invest in early stage, whether it be, seed or Series A focused managers, as Kevin noted, his firm is focused on. And that's primarily, as might be obvious, frankly, where most of the value, is created and where the highest returns can be generated, because, it's where obviously the most risk is taken, where, the valuations are, the lowest and frankly, the most consistent over time. And so, that works very well to the extent that you can partner with top tier venture capital firms to the extent that you have access to them, or top tier partners of those firms that spin out and create their own firms, which is obviously important in terms of having access to the best entrepreneurs and the best deals. But what's important there is exactly what Howard was talking about, which is investing in managers that reserve capital, that have dry powder to support follow-on rounds and make active asset allocation decisions to support the companies that they expect to be winners in the future, and stop funding those that that won't be as promising. On the co-investing side, we historically have certainly in our prior lives at Truvo, had attempted to invest in early stage, companies on direct basis or co-invest basis. And, while certainly, you can have the one-off hits, one of the biggest issues, in addition to not having potentially, reserve capital to fund follow-on rounds, as Howard described, there's an issue of diversification from a portfolio perspective, because even the best venture capitalist and the most promising ideas sometimes end in a zero, and so you need to be able to build a diversified portfolio of early stage investments in order to have the quote unquote multiple shots on goal. And if you try and do it in a more concentrated fashion, it can be very difficult to achieve attractive returns on an overall program. And so what we do on a co-investment basis, is participate in the later on rounds. Frankly, we're most active in growth equity type investments, where you have companies that have maybe $10 to $20 million of revenues plus, or perhaps break even or have a little bit of cash flow, and where you're investing to accelerate growth. To the extent that we're investing in later stage of venture, we're certainly opportunistic there as well. But as the headlines these days would certainly indicate, valuations can often be an issue that you have to overcome in those areas. So a little bit of both. I think from a manager perspective, earlier stages is preferred, but from a co-investment basis, to the extent that you are not able to build a fully diversified portfolio of venture stage companies, being more opportunistic in the later stages would be preferred.
Right. Okay. Thank you very much. I agree with you completely. That's the way I conduct the activity myself. I want a challenge question to you, follow-up though, is for me, a threshold to make an investment decision is basically a 10x return in 5 years. I mean, that's what I look for, and many of us look for. That's a 60+% IRR. How does that correlate with the present valuation? So if it's a 5 million present value, or a 25 million, or 125 million, does that matter so much if you can still foresee the 10x in 5-year return?
No, of course. It has all to do with the addressable market that company is going after, and your assumption over as it pertains to the obviously the market share or that company can get within that market, and then you can back into what you think you're willing to pay from a valuation perspective. I'd say from my perspective, to the extent that we're investing in the later stages, I would say our investment expectations, the return expectations are perhaps not quite as aggressive. It's more in the 3 to 5x range, for individual deals. Of course, the range there is because there's various levels of risk inherent in different types of companies and different stages at which we're investing. But I think you're absolutely right, that you should be willing to pay in some instances a higher valuation, if you think that the market opportunity is huge. But I do think that valuation does come into play, particularly at the later stages where you're having to play higher absolute dollars.
Right. Okay. Thank you very much. Kevin, my prepared question for you was, can you tell us more about how you go about selecting the managers in whom you invest? And how do you look at their past track record or the new manager question?
It's a great question. I think for us, we're not necessarily concerned about whether a manager is experienced or new, because there's certain characteristics of managers that we look for at the onset. The first criteria is, one, has the manager been an operator or a founder before? And kind of giving some background to that question is, we did a survey. Well, Paul Gompers did a survey at HBS that said, what is the most important thing for success at a venture capital firm? They surveyed over 1,000 VC firms at the early stage. And the number one answer from all of those GPs was access to the best entrepreneurs. And the critical importance of that is that VCs do more than just write a check. And especially in today's environment where there's so much capital in the market, VCs have to be able to bring more. They have to bring their expertise, their guidance, their support, and recruiting, et cetera. So in a bi-directional market where entrepreneurs can choose the venture capitalists that they work with, and VCs can choose the entrepreneurs that they work with, and even further up the line, VCs can choose the investors that they want in their fund. There's a lot of asymmetric activity that's happening, such that to be the best VC, you really have to be good at doing all of those different things. And there have been so many stories over the years where you'll have a venture capital firm that was in the right market, but they didn't have the ability to select the right entrepreneurs, and those funds struggled. So for us, we're looking for VCs that can attract the best entrepreneurs and can do that consistently, fund over fund over fund. And there have been cases where it's a new manager who has an established track record as an operator or a founder, or they were a prolific angel investor prior to starting their own venture capital fund. And we've invested in those first-time fund managers as well, and they've done exceptionally well. So I think that there's a lot of qualitative data that plays a part in how you select early-stage venture capital fund managers. And so much of it is network driven that if you're outside of that loop and you're looking to analyze what's happening quantitatively, one, you might miss out on a really good manager, or two, you might miss out on a very good vintage year. So there's a lot of different things that we take into consideration on the qualitative side before we start digging into what are the performance metrics of, say, a manager that might be on their second or third fund.
Okay, so my follow-up or challenge question to you on these remarks is, there's, I think some of the financial hubs, like the coastal US, the Silicon Valley, the New York metro area, they have outsized sort of mental place in our perceptions of the world. Do you think that the way they approach the market and this activity is the best way, the only way, or simply one way?
I think it's simply one way. I think that venture capitalists are learning that as well, as more and more of them look to expand outside of those core market areas. And especially with the pandemic, it was just proof that through technology, you can, one, start companies faster, you can access more markets, and you can have strategic people in places to nurture and build relationships with the best entrepreneurs coming out of those areas. We've seen that, and I'm in the Midwest. We've seen a flurry of activity from Chicago down to Austin. So I think that that whole dynamic is changing. And also from a diversification standpoint, technology just doesn't come out of Silicon Valley. So we've had some of our best managers where 50% of their investments are outside of the Bay Area. And it's something they tout. They'll show that in their presentation decks about kind of the other cities that are coming to the fore, Miami, Denver, et cetera. So no, I don't think that the coastal cities are the hubs anymore. And I think that that's going to continue to change over time.
And we also talked earlier about the whole unicorn fixation versus other ways of producing the overall IRR.
Right, right.
Okay, excellent. Thank you very much. Now I'd like to move into a few minutes of just putting up some important questions of the day and asking whoever's motivated to comment on them. So for you three gentlemen, anybody want to talk about exit environment and patterns, stages, size, mechanisms, etc.? Anybody willing to take a shot at that? Howard and then Jerome, I think, both want to take a whack at it.
Sure. Listen, I think from a high level, we're in an interesting time period. I think that the rate of technological change and advancement has never been greater. But at the same time, valuations appear to be extraordinarily high. A lot of people have big embedded gains in their portfolio, assuming that they can create liquidity out of them. And it's sort of an interesting, inflection point for a lot of us. A lot of us who are old enough were really trained as fundamental value analysts or fundamental analysts with a value bent. And historically, you were trained, you buy something, you set a price target, it hits it. Unless something's fundamentally changed, you exit. But there's a school of thought here, particularly when there are evolving technologies and there are new markets being created. Once it was search, social, mobile. These are enormous TAMs, and it is proven, it's turned a lot of our traditional thinking on its head, which is rather than sell these things when you've made 2, 3, 5 times your money, whatever it is. One of the things we've got to confront today is that there are some of these long-term compounders that are out there. And some of the traditional metrics that we were trained to look at, as securities investors, maybe we've got to, reconsider. You got to be smart about it, but there are perhaps situations where you've got to reconsider whether or not you really sell your winners here, or whether there are some that you really want to be long-term compounders. On the other hand, there is something to be said about harvesting gains when you can, when you've had private companies that you've held on to a long time, and either in the private market and secondary sales, or in the public market, whether it's through M&A, IPOs, SPACs, you have an opportunity to take some money off the table and either redeploy it or sit on it until you see a market correction. And there are a lot of interesting things to consider here. And like most things, only with the benefit of hindsight do you know whether you made the right decision. Also, I know we're running short on time, and I'll flip it back to guys who as fiduciaries run portfolios as opposed to myself, where I have more freedom running a family office. But I'm always sort of aware of some of the competing initiatives or concerns.
Right. Well, I understand what you're saying. Jerome, I think you had your hand up as well.
Yeah, it looks like Kevin wanted to jump in there as well, so I'll make mine quick. But I was going to speak to more, sort of market dynamics, if you will, and to a large extent, agree with Howard as it pertains to obviously the valuation environment. You can see that, over the last decade or so as it pertains to VC exits. A bad year was 40-50 billion in exits. A good year was 120 billion, something like that. In the last 2 years, we've seen, $250 to $300 billion, in exits, but with a similar exit deal count, which obviously speaks to Howard's point as it pertains to the higher valuations, that you're seeing at exit, and we've certainly seen that as it pertains to the median and average exit values of companies, whether it be through IPO, or M&A. And so, it's definitely been, a good exit environment the last couple of years. Part of that is, that companies are staying private longer, right? Because, frankly, there's a lot of regulatory oversight and a lot of scrutiny on the part of public shareholders. Once you're a public company, and to the extent that companies don't have to go public and can access, large amounts of capital in the private markets, they've continued to do that and raise, large rounds of capital in the series, E, F, G, and whatever it may be. And so as a result, when they do exit, primarily through public markets in those types of situations, they are, much bigger companies, more developed companies, and they thus, demand much bigger valuations. I'd say the other thing is, we've also seen, the advent of new exit avenues. I mean, it used to be, basically you'd have, strategic M&A exit, or you'd have a public listing, a traditional public listing. And we're now seeing alternative avenues there as well. So obviously, SPACs, have been all the rage over the last, 18 months or so here. Obviously, record SPAC issuance last year. There were 250 SPACs that went public last year to raise $75 billion, which was more than SPACs raised, through their entire history prior to that. And so, a lot of those are out there, trying to acquire companies, and venture-backed companies have become, a big target for them. And then the other avenue is the direct listing, right? We've seen a few companies do that, and some more in the pipeline. And so just more opportunities for companies to go public.
Thank you. Kevin, I saw your hand finally. Pardon me for missing it for a moment. When you add your remarks here, I wonder if you want to take up the question or challenge, are the companies different, or is the market different because money is being created hand over fist today? There's a whole lot more money that people have and are willing to spend. Is that part of the evolution which Howard and Jerome talked about?
I certainly think so. There's obviously the technology advancements in starting a company are so much easier. I mean, AWS has just transformed a company's ability to go public and do so much more earlier. And what we've seen is early stage companies, they're 3 or 4 years old before they even approach a venture capital firm. So they're a lot more mature. And then to Jerome's point, the heightened regulatory environment that we're in, a lot of these companies said, well, why should we go through the hassle of a public listing when we have all these non-traditional investors coming to the fore who are allowing these companies to say and forego any sort of public listing. So for us, the changing market dynamics are certainly a concern. And what we've seen and been troubled by is just the pace of fundraising for a number of our VCs, where normal time period before was 3 to 4 years where a firm would come back to market. Now we're seeing firms come back to market in 18 to 24 months. Now, again, is that flurry of cash rushing into early stage technology and life science is going to change? I'm not sure, but I do think that this change has been happening for the last 20 years. I mean, you see it in the public markets where you have 50% fewer public companies. And I think the SEC is welcoming these SPACs. I do think there's some concern there in regard to the regulations around them. I think there was some issuance of they're going to start digging deeper into, are there any sort of conflicts of interest with these GPs bringing some of these SPACs to market? So there's a lot of things changing. It's happening in real time, but I do think the two are interrelated, Charlie.
Hey, Kevin, I'd also be shocked if the SEC continued to allow companies going public via SPAC to use projections as similar to what you're allowed to do in the case of traditional IPO. I'll just be amazed if that issue doesn't get addressed.
Oh yeah, I totally agree, because that has just been heard of for them to do that, as well as the SPAC sponsor being able to take such a high portion of, a 20% profit right off the top without anything happening. So there's a lot of things happening. There's a great paper on this. I'm happy to share it with anyone who's interested, but I totally agree with you, Howard, on that point.
And through limited financial disclosure as well.
Exactly.
Although I do think that the sponsor equity promote, there's a market clearing mechanism that will correct that to some extent. The pipe investors, the underlying owners of the business that's going to be merged will force a new market dynamic on that, particularly as there's more competition. But I don't think that there's any natural market mechanism to get these companies to cut back absent regulatory constraints on promotional material, particularly as it relates to projections.
Right. I'm just going to offer a comment, and then we're probably going to be closed out by Kevin. And that is that I think the world continues to change. And, in the news these last few days with the Archegos disaster debacle, just because an entity is private doesn't necessarily free it from oversight. It certainly can impact the world. And combine that with the ongoing discussion about whether our focus as fiduciaries is on our shareholders, like the owners of the companies, or on the stakeholders, which is the broader society. I think a lot of these issues are going to be changing in a substantial way over the near future.
By the way, I won't cut you off. We did have a few questions on the box. I love to see the back and forth, and glad everyone has. I'm sure you have 50 other questions you could go through. One question that came in from Thomas Mahoney with his family office was, how do the panelists feel about investing with VC managers outside the U.S., for example, Europe and so on? I know Kevin Moore had commented, not all VC expertise comes from Silicon Valley. So what do people think? And then if you have a question to wrap up, you can take a couple minutes, but I think we'll start to lose people. Go ahead, carry it out.
All right, well, I'll just make a comment. My answer is that I am in the US, but I invest globally. There's always a learning curve and a different legal system and a set of customs. So I'm cautious about it, but I've made investments in half a dozen countries and will add to that list because, as you say, not all good ideas and opportunities are in our own backyards. Anybody else want to chime in?
I certainly think that there's tremendous momentum in Europe right now. What I've heard from entrepreneurs and VCs over there is that in the last 10 years, they've marked a number of really strong wins. We've historically invested in Israel. We have a little bit of exposure in China. I think China, as much as people in the United States talk bad about China, there's a lot of great things happening there. So it's a market we're looking into.
Any other comments on this outside of the U.S. question? Global.
The only quick plug I'll make and agree with Kevin's comments as it pertains to Europe and China. The only one I would add to the mix, perhaps counterintuitively to a lot of folks is Japan. There's actually some interesting things going on in Japan right now. We actually just committed to a growth stage VC fund in Japan looking to capitalize on the emerging opportunity set there, where historically, as we were kind of talking about, companies would go public after the Series A and B because there really wasn't late stage financing available, to companies, and then they would go public on this lower exchange called a mother's board, and get stuck there in liquidity purgatory. And that dynamic is really changing. There's now more capital available to facilitate the later stage growth of emerging companies in Japan. And it's a huge opportunity because the technology penetration there is pretty low. And so there's some interesting opportunities to be had there.
From our perspective, we were early investors in DD, Meituan, TikTok, a number of companies. Clearly, whether it's China, it's Japan, particularly India, I just think that the level of diligence and scrutiny is much higher. But I think it's impossible to be a tech investor today and not have exposure to China, given what's going on there, particularly if you're a fintech investor, and in a number of other areas. I think that, there are different challenges if you're doing it directly, or if you're trying to access, VCs, go in via VCs who are buying companies in China. You got to really make sure you understand what their on the ground capabilities are, where their competitive advantage is, again, so that they're not suffering adverse selection as we discussed before. But I think particularly as a tech investor, you can't not be looking at and investing in places like China and India. But you've got to really be very circumspect about everything you do there.
A comment that I've heard several times is that many regions, or most regions of the world, have companies and they have markets and they have resources and finance, where I've often heard an opinion is that they don't have as well developed an investment or infrastructure, the people on this call and listening to the call. And so if that's true, that presents all of us with an opportunity.
Yeah, but I will tell you, Charles, just as one comment, together on a company with a number of very high profile investors, we invested in a company in India. Mm-hmm. And it turned out there were a bunch of problems. And like most Indian companies, US investors invest through a Mauritius holdco. Right. Well, it turned out that we had virtually no legal resource. Right. Through Mauritius. The courts in Delhi, in India in general, are non-functional. They are adverse to foreign interests. I've come to the conclusion that if you have a problem, a legal-based problem in in India, you might as well write it off. We went through a period, we were probably spending $1 million a month on legal fees in one very large transaction we were invested in. And over the course of 5 years with very high profile co-investors in jurisdictions, including the US, UK, Mauritius, and India, we couldn't get any legal satisfaction.
My only answer to that is invest in those territories, those regions, with a co-investor from that area who has the understanding and resources. Yeah. I think that aligns interest and helps a lot.
Yeah, we did there as well with Indian nationals, who turned out to be the problem, notwithstanding their pedigree. But it's interesting, it's turned out to be much easier to invest in China and perfect our security interest than it has been in India. Mm-hmm. Go figure.
Well, that closing tip is a helpful way to close out what was a scary topic there for a moment. Look, there are a lot of opportunities. There are a lot of potential pitfalls. And I thank our esteemed speakers for chiming in to help our audience to navigate some of these issues. And I hope we can continue these conversations. Charles, thank you so much. Dr. Sidman, you've been very helpful in putting this together. Howard, thank you. Kevin, the other Kevin, thank you. And Jerome for joining. And folks, I'd like to thank all of our speakers and for all of you listening in. And our next webinar will be June 2nd. discussing reopening and reinvesting in private equity. And you can sign up now on the websites or using links that will be sent out to you shortly if you registered here. And we'll be announcing more details, and we're still open to speakers and ideas for those topics in June. We try to stay flexible so that we can adapt to changing times and so on. So hope we all have a chance to talk at some point. As a final reminder, Private Markets Insider is a platform for identifying investors, funds, and deals through relevant content and this community. So feel free to reach out and chat about what you're seeing and what you'd like to see. And I may follow up with you to chat soon about deals and funds that may fit your interests. And meanwhile, I sincerely hope you're staying safe and sane as spring, green shoots, and sunshine start putting more smiles on our faces. And with that, I bid you goodbye, everyone.
Thank you all. It's been a pleasure.